the webinar today, so please stay on mute throughout the presentation. If you do have a question throughout, you are welcome to utilize the chat function, throw your question in there, and we will be sure to get to it. And there will be a time for Q&A at the end where you're welcome to unmute yourself and ask a question. But until that time, we please ask that you stay muted. And with that, I want to go ahead and introduce you to Jonathan Weaver with Mon Valley Initiative. And Jonathan, you can go ahead and take it away.
Thanks, Elizabeth. Thanks so much. I appreciate you having us this evening, and hopefully something in this presentation will help you something as you're looking at home ownership. And I think that first step is often the scariest step, is just to get started. So I certainly applaud you for taking that step today. I will apologize up front. I am not fancy. I don't do fancy slides. I wish I did. I don't have that talent. And so, just bear with me, and I'm sure that hopefully there's something in here that you'll find of value. So, tons of things across my mind. But when I think about preparing for home ownership, I've always thought it's kind of backwards, that the person who needs to know the most is the buyer, and usually in first-time home buyer situation, that person knows the least. So I just try to share some ideas, some experiences that I have that hopefully give you some inside information on that journey towards home ownership. So going to my first slide here, I have, let me give you a little peek inside my life. Since the pandemic, I have put together a habit tracker, just tracking habits that I want to do. So obviously exercise and that is important to me. You can see they're hugging my wife. I do a pretty good job of doing that. So all you do is you put the habits up that you'd like to have, and then you mark off the days that you get to do it. So napping, again, I'm pretty good at that. Putting, I'm a golfer, and my putting's horrible, so I always want to practice that. Here's what I want to share. Send money to savings, and the process of buying a home, so much of it that we're going to cover today is about how to accumulate funds to make that happen. It is such a big part of it. Sit outside. So we'll have a link at the end if you want a habit tracker. If you want me to send you a copy of this, I have my email at the end of the presentation, and just send me an email and I'll be sure to get that out. So first slide I got here is your lender. So in order to buy a home, I always thought the best thing to do is think about what a lender wants. And if we know what they want, then we can kind of figure out what we want to do in order to give them what they want. So in my mind, there's 4 things. So that's pretty simple. 4 things that a lender wants to check when they're looking at your loan request. And the first one I put up first because it's the appraisal. And so for you as a buyer, there's nothing you can do about number 1. There are no action items in my mind for you to do. So, just be aware that an appraisal was ordered. It's ordered from your lender. They're the client, and it comes back and tells them what's the value of the home that you're buying. So if you're buying a $150,000 home, the bank wants to see that it's worth $150,000 or more. The second thing I think a lender is looking for is what can you afford? So what's your income? So them calculating what's your income, and that can vary if your income's commission or tip or hourly with overtime. There may be some calculations and them trying to figure out what your actual income is that they will count. And then it's checking, that income versus known things, the home payment that you want to buy and the home payment that you have with other debt, which we call debt to income, and that's something that they check. Here's the 2 things I think we can worry about, and 2 things that we're going to spend some time with this evening is, do you have enough cash? Do you have enough cash to make this process work? And the last one, the 4th one is your credit good enough? And we'll touch on those to help you understand what good enough is and how we can help you get there. So, I told you I'm not fancy, so I tell people roughly it costs about 10% of the purchase price in cash to buy your home. So that's pretty scary, right? If you want to buy a $100,000 home, I'm telling you need $10,000. And example after example, we're going to come in there close to being that rough 10%. So I want people to at least know, what is that number? What do I have to work towards in order to be a homeowner? So we'll start there. So 10% of the purchase price. And, I remind people, it costs money just to get started. When you sign a sales agreement, your realtor, if there's a realtor involved, they're going to want $500 to $1,000 in hand money. A home inspection, that's something I think that people should do. That's someone that you hire, someone that I would love for you to be there during that home inspection. That's about $500. We talked about the appraisal. That's something the lender will order. Well, you have to pay for that. So it's $1,500 to $2,000 just to get this process started. So certainly saving to have that is important. So people say, well, 10%, where does it, what's that for? Why do you have that? Well, the first thing that makes up that 10% is down payment. So, I'm saying 3%, it could be 3%, it could be 5%, it could be 3%, but somewhere in that range of money that you're going to need. So that's 3% of the purchase price. So if it's 100,000, we're talking about 3,000. The second part is closing costs. So those to me are the legal expenses. Those are the items that it takes to make this transaction legal. And the next slide, we can talk about some of those things roughly. And the title insurance policy, the appraisal, recording the transaction in the county courthouse costs about $400, the bank fees. And so roughly that number, those closing costs, I think are about 4%. So we have 3% for down payment, 4% roughly for legal expenses. And then lastly is escrow. So that's just a French word, and it basically means savings account to pay your taxes, pay your insurances on your home, and that's about 3%. So that, as I said, that goes for savings to add to your taxes and homeowners insurance. And every home is going to have 3 taxes. There's a county, there's a school, and there's a local. Your county is the smallest tax, your school is the highest tax, and we have to put money inside into a savings account to prepare to pay those as they come due. Here in Pennsylvania, we pay forward, so we pay ahead of year. So when we're talking about money to buy that home, I think you have 2 choices. You can either earn more, so overtime or second job, ask for a raise, maybe get a whole new job. Maybe this one isn't working out for you. Maybe you can walk dogs, bake cookies, let everybody know that you're wanting to create money. You're trying to create revenue. And I think once you get that word out with your friends and family, people at church, they might be able to help you point to opportunities to try to make some extra money. And then your other choice as far as having money for buying your home is to spend less. So no matter what you earn, you have to spend less than what you earn. And that is a difficult part of purchasing a home. So we're going to go to this. This is a profit show that my wife and I caught this spring, and I loved it, and she loved it. So just take a listen. Let's see if we can get this to work and see if we can. Thanks, Grant. So what I like about that is that's talking about business, but I think you can really easily make the leap of how to make that part of a household, right? A household to me is a business. So, those little inefficiencies, it's a little bit, we're just going to go to dinner. It's a little bit money here. We're going to stop at McDonald's. It's a little bit money there. It's adding up those little things that begin to be big things. And that becomes whether matter you're in the home purchase process or you're still on the sidelines. So it comes to budgeting, and budgeting is not a dirty word. It's creating wealth. It's not about your income. It's about what you spend, and spend less than what you earn. And I believe that your bank statement, when I meet with people, I ask them to bring in a bank statement because we are all buying things on our debit card. So everything we buy usually ends up on your bank statement, and I think it begins to point you in the direction of where your money is going. And I'm a big believer that as humans, we lie to ourselves all the time, and especially about money. We don't do a good job of talking about money. Most people didn't talk about money at their dining room table or in their household. So being honest with yourself, looking at a budget, I think, is a great way to help pave the way for you to be a homeowner, to begin to identify areas where we can create savings. So, I try to do a little system, and my wife comes home from shopping. She shows me a bag of clothes, and she said, "This was $100, and I used a coupon, and I saved 20%." And of course, I'm such a pain. I remind her, "Well, you didn't save anything. You haven't saved anything less. You just spent $20 less." It's not savings until we move that money from our checking account into some sort of dedicated savings account. So that's why on my habit tracker, I have that to remind me I have to move money from my checking account into my savings account to actually make it savings. And you have to help figure out what that savings account looks like. So, we're all pretty much the same. And savings will always come last. So when people do a budget, they say, "Well, I'll save what's left over." That never works. If you want to be a homeowner, one of those big tips is you've got to save first. You've got to save that $50 a paycheck, or 25, or 125. No matter what you can, whatever you can do, we've got to get that in there first, because if it comes last, there'll never be any opportunity to save any money. So savings has got to come first, and not last in our journey to home ownership. When people talk about buying a home is hard, to me, that's what's hard, is the sacrifices, the choices we have to make in order to save money. I want to go out with my friends. I want to go have a couple drinks after dinner. I want to go on vacation. I want new shoes. Those are the hard things to give up as you're moving towards home ownership. And it's, as you see, it's those small things, like they said on the Prophet. It's just little thing after little thing begins to create wealth, create savings in order to help you purchase your home. So this is credit. So credit. Now, obviously, credit is the second part that we worry about of the four things that a lender, I think, looks at. And so we've all seen this pie chart. It shows us the 5 factors that are included when our credit score. So the biggest portion, of course, is payment history. Second part is amounts owed and length of credit, new credit, and type of credit. So I tell people, that's a lot of things to worry about. I say, don't worry about the yellow, green, and blue. Worry about the orange and red. Worry about whether your payment is on time. Worry about how much you owe on your credit cards. Length of history will take care of itself. Your credit cards are as old as they're going to be. You can't make them any older, so we don't worry about that. New credit, well, opening credit, new credit brings down your credit score. And mix, I wouldn't worry about the mix or type of credit you have. So let's control what we can control. Be on time every time. If you're coming up to the due date, I want you to be nervous. That means that it matters to you and care. The second part is, how much do I owe? So if it's a $500 credit card, if you owe $400, then we know that that's going to drive your credit score down. So looking at those ratios, looking at that available credit to make sure that we are not getting too high. And the simple rule of thumb, I think most people hear, is a third. So if you have a $600 credit card, we don't want to be over $200. And a real simple way to think about credit, I think of negatives and positives. So you have certain items and it's either a negative that month, such as in collection, a judgment, a late payment, your balances are too high, or you have new accounts, or positive. So your payment is on time, your debt load is low, and it's stable. It's not new credit. So my job is to kind of show people we want to have more positives a month than we have negatives. So when I coach people, I want them to try to work towards having 4 trade lines, 4 accounts that are open and greater than 12 months old. And that's not really true. I've seen some examples recently where someone's come in with 2 accounts that are 6 months old and they are in the process of buying a home loan. So, this is what I've historically thought was a good mix, but it's not necessarily solid, right? There's some lenders out there doing some things where maybe you could see less over a shorter period of time. But I think this is a good goal to work towards. Also, people say, well, how do I build credit? So Fingerhut. Now, Grant, if you can open that link up here, I want to show you Fingerhut, and I'm going to tell you, I think Fingerhut is a terrible credit card. It is not one that I particularly like, but Grant, if you can go up to that apply now up at the top. And scroll down to the bottom, there would be the disclosures. Right there, yeah. So look at the disclosure. This credit card is 29.99%. That's why I'm telling you this is a bad credit card. That is horrible. But we're going to use it in a way where we're not exposed to that. Scroll down a little bit more, Grant. Let's see if I remember there was a late payment, and right there, I think it was, there's a late payment where they can charge you up to $40 a month for a late payment. So, please accept that I know that this is not a good credit card. Go up to the shopping section, but I'll show you how I would love to see people use this. And so we go shopping here, and I would say go to, what do we say, home and kitchen gadgets, I think we were on. Yep, so here are 5 spatulas, and they're charging you $50 for those spatulas. And I'm going to tell you that's a horrible price to pay for 5 spatulas, because we can go to Dollar Tree and get those 5 or 6 spatulas for $5 or $6. So $50 is way too much to pay for. But what I would tell you is, you buy the spatula and you wait for the bills to come in, and then you pay half of it, and you make no other purchases at Fingerhut. And then the next month, they're going to send you a bill for $25 plus some interest, and then I'd want you to pay that in full. And then the next month, go down and buy the cutting boards. How much are the cutting boards there, Grant? $29. Still way overpriced for those 3 plastic cutting boards, way more than you should pay. But, we're going to charge those cutting boards, pay half, and then the next month, we're going to pay them in full. So that's one option to help you try to build credit. It's really easy. I've talked to a lot of people, and the success rate to open a Fingerhut card seems to be pretty high. So we're not going to Fingerhut to buy stuff. And that's what I want to leave you with. We're not going there to buy stuff. We're going to Fingerhut because we want to get a credit score. And Fingerhut is that tool that we're going to use to get that. A carpenter doesn't want a drill. What the carpenter wants is a hole, and the drill does that for the carpenter. So we don't want Fingerhut. What we want is for Fingerhut to help us buy a home. And we're going to do that by buying smallest things we can find and making those payments on time to help build our credit. And then once you buy your home, you can always go back and close out that Fingerhut, which I think would be a smart thing to do. Second way to build your credit is secured credit. Capital One's one of those easy ones that I've had experience with. And then you put up your own money as collateral. So you can put up $200, and now you have a $200 credit card. So one of the biggest mistakes that I see with people with secured credit is, to them, that's their $200. And what they do is they go out and they charge up $200 on their credit card. And I understand that. But the way I would want to suggest or position this is you use that Capital One card for one transaction a month. Maybe it's a tank of gas. Maybe it's McDonald's one time. And then wait for that bill to come in your front door. And as soon as it comes in your front door, you sit down and make payments arrangements for it. But that's secured credit. And remember, you have $200 there. So it's kind of like a little mini savings account over there that you could access once you close that account. Another real easy way is authorized user. And you can do that this afternoon. And so, you identify someone in your life that might be willing to add you to their account. So I always remind people, be careful who you ask, because if they pay their bill late, it looks like you've paid your bill late. If they charge $10,000 on a credit card, it looks like you've charged $10,000 on a credit card. So you have to be careful and mindful, and vet the person that you actually want to ask to help you do that. But what's great about that is it's immediate and gets you their account. We have a program here we call Twin Accounts. The only reason it exists is to help people obtain credit. It's a $27 a month payment, and we do it for 12 months. It's an installment loan, so it has a beginning and it has an end. So in a credit mix, that's a higher value kind of account. And so at the end of that 12 months, you have $300. So those monthly payments actually go, instead of paying something down with Twin Accounts, you're actually paying something up. And at the end of that 12 months, we can access that $300 for you. Here's some things I would say are potential pitfalls. Rent-A-Center. One of the things I don't like about Rent-A-Center is that they only seem to report your payment one time. So if you rented a sofa and you did it over 12 months, you made 12 months of payments, they only show one transaction. They only show the last payment on your credit report. So yes, they do report to your credit report, but it doesn't have the best effect because they only show one transaction. If they show all 12, that would be better, but they don't. Car dealerships, you have to watch car dealerships. They're liars. They will tell you that based on your credit, they can only get you an 18 or 19% car loan, and that what you should do is make 12 payments and then refinance the car for a better rate down the road. So, if you've heard that, just let me know. But the problem is you can't refinance the car. A car is a depreciating asset. Most lenders, most banks don't want to refinance those because they go down in value. Plus, in that first year, you've not paid in enough fast enough to make that to make that balance go down. Christmas Club loans. I've seen some credit unions that offer some shorter term loans to help people get through the holidays. And what I don't like about that is they are shorter term. So what happens is they do a credit inquiry, so your credit score goes down. They give you a loan, so your credit score goes down again, and then you repay it over 4 months. So you never get the lift. You never get above higher from where you were. So I've seen that recently, and certainly something to keep in mind. Check cashing, of course. Usually those things don't show up in your credit report unless you don't pay. And then I do not like One Main, Mariner, Beneficial, whatever you want to call it. And I don't like them because they're really good at what they do. And what they do is they check in with people. And they check in with people every 3 months. And they ask them, don't you want to go on vacation? Don't you want to borrow money to consolidate? Don't you want to get some money for the holidays? They're very good at doing that. So those are things about credit. Loan options. So there's so much out there. So I like to weed out the things that I don't have to worry about. So if you're not a veteran, you can't get a VA loan. So don't worry about that. If you don't want to live in the country, then maybe a USDA rural housing loan is not for you. So for me, I think about Elizabeth, PA. Outside of Elizabeth, you begin to get into areas that rural housing would work. So there's 4 main loans, and here's 2 that probably don't impact you. So these are the 2 that we're left with, which would be a conventional loan and an FHA loan. Most of my clients, I see that we end up with an FHA loan, and we're going to show you kind of how we get there. So one of the big things about conventional that's good is that it has this monthly PMI, so private mortgage insurance. So what private mortgage insurance does is it protects the bank. So you pay for it, and it protects the bank. So it protects the bank in the event of foreclosure. So if your home were to be foreclosed upon, PMI, private mortgage insurance, would pay for winterization. It would pay for a new realtor to market my property. It would pay for the legal fees that it takes to kick me out of my home. So that's what PMI covers. So with a conventional loan, it goes away at some point at that 80% loan to value. Whereas on an FHA loan, as I've noted here, it never goes away. So that is a downside of FHA, is that mortgage insurance is what we call life of loan, and it will stay with you. And it's $50 or $75 or $100, depending on what your loan amount is, but it's going to depend on what your loan amount, how much that is. But that's one of the upsides of conventional loan, is that mortgage insurance goes away. So if you look at this chart, and it's a little bit overwhelming, but if you notice there, it says 1 unit, purchase, fixed rate mortgage, 95% loan to value. So you put down 5 cents on a dollar, your lender brings 95 cents. Here's the credit score requirement. If your credit score is 660 or higher, they're going to require that you have 6 months of reserves. So what reserves are monthly mortgage payments. So if your monthly mortgage payment is $1,000, if your credit score is 660 or to 680, they're going to require that you have 6,000 extra dollars in reserves. You can see there if your credit score is 680 or higher, then there's no reserves. There's no additional reserves. So then you say, well, what if it's under 660? Well, if you put 25% down, they'll go to 620. So for most of my clients, that's not possible to put 25%, $25,000 down on a $100,000 home. So the credit score requirements are a little bit higher on conventional. It also requires greater reserves for those people in that 660 to 680 range of credit score. So that's another reason why sometimes conventional may not be the best tool in your quest for buying a home. So here's FHA. So here it says that your credit score can be 620, and they'll help you with a loan. And then they give you ratios, so debt to income. So that's looking at what your income is versus what your expenses are, and it's pretty generous at 31.43. And those numbers can go up if there's compensating factors. So in the next block down, if you have some reserves, then those ratios, that debt to income, can go higher. So FHA, to me, you can enter earlier into homeownership. You can enter earlier because you don't have to save all those reserves. They do have a 1 month reserve, but you don't have to have 6 months of reserves in order to get into homeownership. Here's the big reason. Here's the biggest reason, and it's kind of circling back to what we talked about before, is that on a conventional loan, the down payment's 3 to 5%, and the seller can pay 3% of your closing costs. Whereas on an FHA loan, it's 3.5% down, and the seller can pay 6% of the sales price towards your closing costs. And let's see how that makes a difference in your getting to be a homeowner. Remember this slide? Remember this slide? I said it was roughly 10%. It's expensive to buy a home. So 10%, that's what we need. Under an FHA loan, if the seller picks up 6%, then we only need 4%. So we can certainly get to 4% savings much faster, 4% of the sales price much faster than trying to save our money to get that full 10% for the down payment. So with FHA, it allows the seller to pick up 6%. So that certainly helps speed your process into being a homeowner. So here's something, there's a lot of words in here. I try to highlight the good thing, but this is a program through the state. It's called Pennsylvania Housing Finance Agency. Its job is to help people with housing issues across the Commonwealth. And here it says borrowers can receive up to 4% of the purchase price as a loan that you repay over 10 years at 0% interest rate. And you use that in conjunction with the PHFA first mortgage. And it says that you need a credit score higher than 660. So let's take a look at the next slide and see how that can be so impactful. It's expensive, it's 10%. Seller's gonna pay 6%. So that means we need 4%. PHFA can help us with 4% as a loan at 0%. 0% is a pretty good loan in my mind. So you need no money. If you have a credit score over 660, you can get into homeownership without any money, which is, a big obstacle for people is cash getting into their home. You do, of course, need money. If you remember this slide, we talked about, having $2,000 just to get started. You're going to need money to move. You're going to need money for new rugs and painting and all those things. So, but here's a couple tools that we can put together to try to help that happen faster for you. So here we are. So as I mentioned, I got my little habit tracker. If you want one of these, if you email me, then I'll be happy to send you one back as an attachment. I meet clients, and we're not meeting any clients face-to-face right now, but I do set up appointments with people on the telephone. We do some stuff through the email. And what I try to do is help people understand where they are, We look at income, we look at credit, we look at debt load, kind of figure out where we are, and then talk about some of these benchmarks and try to figure out what tools might be available to help you with these. I love this time of year. Getting a part-time job in normal circumstances would be pretty easy. Holidays are coming, to budget, to plan what those holidays are going to look like for you. Tax refunds, a huge part of homeownership is people accessing or using their tax refunds to help them get to their goal of homeownership. And spring is just around the corner. So, we kind of go into a dead period here where anyone that has a home to sell, they usually don't want to sell it in the winter. Moving in December or January, February isn't usually the most fun. So we go into a period where kind of the selection of homes begins to go down. It's been such an unusual year where homes this year seem to go on the market and then they get under contract pretty quickly. So, we can use this time to try to position ourselves for something in the springtime, for when houses begin to be placed back on the market, and increase your chances of being a homeowner at that time. So, Elizabeth, I don't know if there's any questions, or if someone has a question, I'd be happy to see if we can help answer anything like that.
Yeah, thanks so much. That was a lot of helpful information. We do have a couple of questions already in the chat too. So the first question is, why would the seller pay 6%?
Because they want to sell their home. It's pretty simple, right? A seller wants to sell. So if a realtor brings them a buyer whose credit is good, who can afford the payments, can afford the debts that they have, and said the only help that this client needs is with closing costs. If I'm a seller, I would consider that. I want to sell my home, so I would consider that. And then part I always remind people is, don't be fooled. The seller isn't paying it, you're paying it in the sales price. So it's factored into their proceeds of them paying their closing costs. So that's a great question. So a seller would want to pay someone's closing costs because it helps them sell their home, and I believe that's ultimately what a seller wants to do.
All right, thank you. And then another question we have is, would PFHA always pay 4%, or does it have to be under a special circumstance given you have above a 660 credit score?
Yes. It's you have to have over 660. So if your credit score is 659, you cannot access that program. And PHFA just makes it available. So it's a matter of knowing about it and talking to a lender that offers it. Not every lender does PHFA loan. So if you go to the Pennsylvania Housing Finance Agency, there's a whole website dedicated to home buyers, and it will let you know what lenders out there participate. And that's a good point. When we're talking about lenders, if you go to a Quicken or a Rocket Mortgage, they're not going to have a PHFA loan available. It's not something that's in their menu of loans. And I find that, Rocket Mortgage and those bigger lenders, they may not be interested in someone that wants to buy an $80,000 or $100,000 home. They seem to want to serve, those higher loan amounts. But, check them out. But they typically aren't going to have special programs. So local lenders, First Commonwealth, PNC, Dollar Bank, West Banco, many of those lenders have what we call first-time home buyers programs that may help avoid that mortgage insurance. That's one of the big things with some of the local programs, and are worth definitely talking to your lender or different lender to find out about some of those programs. But yes, you can't always get the Keystone Advantage Assistance Loan. That's that 4%. But if your credit score is over 660 and you're working with a lender that offers it, it's certainly something that should be available to you.
Great. And then the next question, you kind of just hit on it. I don't know if there's anything else to say, but somebody asked if you could talk about first-time home buyer grants.
I don't always like to call them first-time homebuyer grants because I like to say that they're programs, right? Different programs that people offer. And sometimes programs are open to people. You don't have to be a first-time home buyer, so that's why I don't like to call them first-time home buyers, because that puts in the mind that maybe you have to be a first-time home buyer. But many of them are based on income, and some of them are based on where the home is that you want to buy. Banks are encouraged to lend in what we call low to moderate income census tracts. So we're having the 10-year census this year. So as they go around to different neighborhoods, they make areas and they classify it as low, moderate, middle, or high. So if a home is in a low to moderate income area and you make $200,000 a year, you may be able to access one of those low income grant type programs. Others are based on income. So typically it's 80% area median income. Typically for a single person, that's going to be $46,000 or less. Well, if you made $46,000 or less and you found a home in, say, Upper St. Clair that you could afford, then they may be able to help you with one of those grant programs, first-time home buyer programs. And if you have a lender, I always encourage you, this is a great time to start talking to people. As the business begins to slow down, people have more time. It's been a crazy year for refinancing. It's been a crazy year for purchase. Many mortgage people are not available just based on volume. But as we get closer to the holiday, closer to the new year, business will start to pick up. And it's a great time to learn and talk to people that maybe have information for you.
Great, thank you. Another question we have is, how do student loans play a role in attaining a loan to purchase a house? For instance, if a person has accrued over 100K of student loans.
Yeah, it's a big issue, and that $100,000 in my mind is something that's going to need to be paid, and you would want to definitely talk with your lender. Many people I meet with, they're doing income-based repayment. And if you have a letter from your lender stating that based on your income, your payment is $100, and that is what's given to you in your debt to income ratio. So having that information from your lender, your student loan servicer, on what your agreed upon payment is, they can use that information to calculate what your debt to income is. So yeah, I would think $100,000 loan, if you're paying the regular payment, that's going to have a huge bearing on your ability to get a home loan. So consider income-based repayment. Now that doesn't help you pay off your student loan faster, but it does help you with qualifying to purchase a home. So yeah, student loans are huge issue, huge factor right now. Many times, if you don't have an income-based repayment, they're going to give you a 1% of balance as a monthly payment. So on a $100,000 loan, they may give you $1,000 a month. But you have to talk to your lender, find out how that works, and make sure that information changes from time to time. But income-based repayment, you have it on paper on what your required payment is, and otherwise they're going to have to assign a payment to you. And I don't think most people want that based on some of the balances I've seen. So that's a great question. And again, check with your lender, check with them, and have that conversation on how they approach that.
Okay, and then another question is, what are the benefits of purchasing a house outright versus with a loan?
Freedom, right? I guess paying cash would mean that you're free of debt. Which is a pretty great goal. Yeah, so if I could pay cash for a home, I certainly would. The tax benefit, the annual federal income tax that we file has changed significantly over the past couple of years, where we don't itemize some of those things we used to. So yeah, if I had cash, I'd love to pay cash for a home to provide you freedom. Great question. I hope that's possible for most people I meet. That's not in the cards.
And then we just got another one. I was told you can show a letter from a retirement company also to show funds you have saved. Will this help with the bank?
Yeah, that would help make up your reserves. So when people don't approve loans anymore. Computers approve loans. People put information in, and the computer pulls your credit, and the computer actually does the underwriting. It's called computer underwriting, DULP underwriting. So computers love assets. So excuse me, if you have money saved in a retirement fund, IRA, 401k, you have a CD somewhere, yeah, I suggest that you would give that to your lender so that they can put that in the computer so that the computer can read it and come back with an answer. Clearly, if you have monies and savings, whether that's savings or whether towards your retirement, IRA or 401k, it's only going to be viewed more positive. And I would think when we talked about reserves, we touched on reserves a little bit in the conventional loan. I think that would satisfy that reserve requirement in an instance like that. So yeah, I think in many cases you want to show all your financial savings so that it can be evaluated by the computer, and I think it makes approval much easier.
All right, and then another question we have is, how do you know when you're ready to get pre-approved for a loan?
Well, selfishly, call me. I can pull your credit. We can talk about your income. We can kind of pull those things together and then show you. And if your credit score is higher than 620, higher than 660, you'll have a better idea of knowing if you're ready. If you have funds, or if you know that you're going to get tax refund, or if you know that your parents will give you a gift, we can kind of address the cash side of it. So how do you know? I think people know. You know whether you're paying your bills on time. You know whether you've put money aside. And oftentimes people are afraid to do that pre-approval. They're worried about the credit score drop that it might make. But eventually you have to try, and that's how we, in order to see a home, most often a realtor wants to see a pre-approval. So at some point you're going to have to try. But I think the easiest way is to, if you feel comfortable, call me. If you don't feel comfortable with me, there are other housing counseling agencies all across town that do a great job. And encourage you. I like you to build a team. I want you to find a realtor, put that person on your team, housing counselor, maybe a lender, a home inspector. I'd like you pulling those people together to support you as you go through this process. So how do you know? One, you can always contact me. We can kind of do an evaluation for you real quick. And then secondly is just try. You don't know what you get until you try and jump in the water. And oftentimes you can use that as a learning, say, yep, I'm ready, or no, there's more work to be done.
All right, great. How long is a pre-approval letter typically good for?
Normally 60 days is what I've seen. Everything in the credit world kind of has a shelf life, just like food. Credit reports only last for so long. And it's not uncommon that you get a pre-approval, you go look for houses, you don't find one that's a perfect match. And many times we have to get our pre-approvals renewed. And that's just part of the process, and something that when you have good, strong credit is not an issue. So typically a pre-approval's 60 to 90 days, I would say, on most cases, and that credit report goes stale. It only lasts for a certain period of time. So pre-approval is pretty easy. I mean, it's a conversation on the phone. It maybe takes 10 or 15 minutes, and basically they're determining whether you approve or not based on your credit score. They're not usually verifying your assets. You don't typically send them a bank statement to show them you have the funds. Normally you would do that in the loan application process. If you tell them you have $100,000, they're going to type in there that you have $100,000. So, whatever information you give them in a pre-approval is what they're going to put it typically into the computer to come up with your pre-approval. But to answer the question, it's typically 60 to 90 days.
Thank you. And then, do elections typically have an impact on the housing market?
Sure, there's uncertainty. I think there's uncertainty in interest rate world. There's uncertainty in economic times, what the future is going to hold. So yeah, I think, from an interest rate kind of point of view, I would think that it has a bearing. Um, that's a really good question. I don't know that it impacts people selling homes. Um, yeah, I just think of it from an interest rate point of view. And, you know, these interest rates that we're with today, you know, they figured this out weeks ago. I mean, you know, this was, and interest rates, you know, come from Fannie Freddie, from the Fed. So, you know, everyone's pretty much affected the same way. But yeah, you know, to me, yeah, I'm probably not the right person to ask, but yeah, I think an election has a bearing on it. And we shall see.
All right, we have another question. Thank you everybody for all the
Yeah,
questions.
this is wow, crazy.
Yeah, and just some people are feeling more comfortable only sending the questions to me privately, so you're welcome to do that if you would feel comfortable with that. But this question is, how much, if any, does the pre-approval process affect credit score?
Any credit inquiry is going to change your credit score. I don't know what that means. It could be 3 points, it could be 10 points. We do know anytime someone checks your credit, whether it's for a pre-approval, whether you're shopping for an automobile or a credit card, a credit inquiry is going to have a negative impact on your credit score. So we know that. My philosophy has always been, well, that's why we need to have the credit score as good as we can make it when you go into the process. If you go into the process at 620, you really can't afford to have it take any dip whatsoever. So we don't want to come from a position of weakness. We want to come from a position of strength, where our credit score is 700. And so any changes like that, those are minor in my mind. Any minor changes like that are going to be easily absorbed. And the interesting thing about credit, like if you go car shopping, is you know, they don't do one credit inquiry at the dealership, they do like 20. But there's like, for lack of better words, there's like parentheses, and it's usually 10 days, 14 days, where you can do a lot of credit inquiries in that period, and it only looks like one credit inquiry. And that's done intentionally, because this is the way that we finance cars, and this is the way that we finance homes, is we don't check with one person. Many times we check with multiple people. So, you know, if your car dealership did 20 inquiries, then your credit score would go down rapidly. But those 20 actually look like just one. And you know, the credit reporting agency doesn't tell you all their secrets, but there's some period of time, whether it's 10 days or 14 days, where that all looks like one credit inquiry. So that's a good question. Thank you.
All right, and then another question is, how do I shop around for a mortgage, and how do I know if it's a good one?
I'm strange. We have to agree. I want you to get a good interest rate. I want you to get a better program. It's like shopping around for gasoline prices around town. You know, every gas station maybe offers a little bit different price. So then you end up driving around looking for that best price, and you end up spending more money just driving around. At some point, I just want you to buy gas at a fair price. It may not be the best. I just don't want it to be the worst. So shopping for programs to me is more than rate. It's about what benefits might be there for you. If you're a veteran, I want you to shop for a VA loan. It's a fantastic program. If you buy a home in a rural area, I want you to look at that USDA program because it has some fantastic benefits and features. If your credit score is at 620, you know, then we kind of know that FHAs are entree into home ownership, and it becomes a matter of who do you feel comfortable doing your business with. Shop around, you know, call around, talk to people, looking for a good deal. I just don't want to see I know the car dealer is going to make money on me. I just don't want to be his whole paycheck for the month. So that's, you know, I want you to get a fair deal. But if sometimes people get really wrapped up into chasing the really best interest rate, and I think it drives them, it's too much. Let's get a good rate, fair price, good program, and be happy that we're going to be homeowners. Interest rates right now are unbelievable. I mean, they're under 4%. They've been this way for almost the whole year, and just really a great golden opportunity to lock that in for the life of the loan. We're running out of time.
Yes, we actually, that was all the questions that we have. So I'll give, if there's anyone that's on the phone or anything that can't use the chat, if you want to ask a question, now would be the time to do it.
Good. So, I'm glad that you're here. I'm glad that you're beginning to look at home ownership. Education to me is the most important part, to use this information. Look for another program. Look for, keep learning. Ask people at work, ask people at church, what it's like for them to be a homeowner, and keep learning from people. And I think that helps prepare you for success. And at NBI, we definitely want people to be successful in home ownership. So my email was up there for the habit tracker. If you want that, if you want to set up an appointment, we can do that too. But thanks for tuning in tonight. I really appreciate it. Overwhelming response, and certainly appreciate you, Elizabeth, and people at the Mon Valley Providers Council for helping us get this together.
Yeah, absolutely. Thank you so much for the presentation, and thank you everybody for tuning in. We will be sending out the PowerPoint and the recording of the webinar, so you guys will have access to that, and we'll also include in that any other community resources that we are familiar with. So thank you again, and just be on the lookout for that information. And you also have my email if any questions come up as well. So thank you all for tuning in.
Thanks, everyone. Good night.